Hello, good evening, everyone. Welcome back to Finance Lingo. In this video, I'll be sharing with you a finance stock in this present market situation where there's trading war ongoing, and the U.S. markets and the Hong Kong and China markets is having a very severe correction right now. Does it mean that investment opportunities doesn't arise? Should I start investing? The answer will be no. It's a little bit difficult, but nonetheless, all these trading wars could present you a lot of investment opportunities if you know what to invest in right now. So nonetheless, a lot of people will be looking for some lower risk investment right now, and apparently I did some homework on stocks, and I think it's very good. But nonetheless, let's get started. Okay, so this video is a presentation to you for general information only and does not constitute a recommendation or offer a solicitation to subscribe for or purchase or sell the investment product mentioned herein. Okay, so let's get started. Basically, this stock, what I'm saying is right now is Leong Finance. It's a stock listed in Singapore stocks market, and presently today is trading at the price of, let me see, Leong Finance today on the 28th of June. Okay, this stock presently is trading at 2.64 Sing dollars per share. Alright, so this is Leong Finance. So let's get started. Okay, this is the stock analytics. Okay, to achieve this, to get this information, remember, just need to go to the stocks. Ahead, look for the stock name, right click stock analytics, and you'll be able to obtain this information here. So as what? Okay, let's get started. On the top left column here, this is the financial analysis ratios. Okay, so let's get started on these stocks. Okay, these stocks have a market cap of 1.1 billion in size, are very large to the considered a large cap to the stock market. Okay, pretty decent company. Okay, this stock is a low volatility stock trading at a beta of 0.7. Okay, when we look at this ratio, this stock, one thing very interesting is that they do not issue any long-term debt to the market, of course. Okay, then and next, the company is enjoying a pretty good net profit margins, good dividend yields of 4.9% based on the history rate. As what we can see, the company is a very generous company, giving a payout ratios from their net profits to the shareholders at a rate of 60% out of the net profits. Right, the PE ratios right now, it's trading about PE of 12.3. And one thing I do like is that this company have a book value of 4.13, and it's presently trading at a discount of 0.64. Okay, that means you are pay for every dollar you for every 64 cents you're actually buying a $1 worth of assets in this company. Okay, but this is just a layman kind of explanations to simplify. All right, so now let's look at the past 5 years of their interest income. So as what you can see, the interest income have been rising steadily over the years. All right, as what you can see, all these interest income is growing at a very steady state. Only a slight dip here. Well, no doubt there's a slight dip in the interest income, but when you look at net profit, the company is able to generate a much higher interest income. Okay, so this is a very interesting. So, and the net profit for the past 5 years had always been a positive. So now let's look further. The company accounting book value is growing over the years as well. And what we can see here is that they do not have any long-term debt as well. So okay, and then look at the dividends. Okay, the company have been giving dividends very generously. As what you can see here, that for every in the past, in 2003, for every is about 16 cents. Okay, they give out 12 cents, and for every 14 cents they give out 10 cents. So you can see here that the company have been very generous. When the company make less, they actually distribute less. When the company make more, they actually distribute more. So very generous companies. They do not stash away their profits, hide their profits from the shareholders. So that's why you can see these are very generous companies. The shareholders and interest and the company interest is in line together, and the company will not will always be reward shareholders when they make more profits. Okay. So likewise, this is the finance companies. In any retail investors or anyone basically can open a business current account or fixed deposit account, savings account with them, with Leong Finance, including car loans or even housing loans. with them if you like to support this company. Okay, so this is the financial ratios. So now the question is, how do Hong Leong Finance compare with the other local banks? Is the ratios more attractive or is it less? I'm just going to compare with DBS right now. So this is DBS financial ratios. The company is of course much larger. Well, you can see here it's about 69 times larger than DBS Hong Leong Finance. But nonetheless, it doesn't mean Hong Leong Finance is a small company. It's a very large company as well. Okay, so but if we compare the beta relative to Hong Leong Finance, the beta of Hong Leong Finance to the market is at 0.7 versus 1.44. Okay, so DBS offer a higher beta as compared to the Hong Leong Finance. Look at the debt to equities. Hong Leong Finance do not have any debt, so DBS have debt. So in this case, Hong Leong Finance wins with a lower debt. That means a lower risk. Okay, and the net profit margins, Hong Leong Finance perform a little bit better. Okay, they are good net profit margins, and the dividend yield aspects, Hong Leong Finance still did better as compared to DBS, now as offering at 4.9, and DBS of about, based on history, about 3.5 right now percent based on the present share price as of today. Today's share price or yesterday's share price, you are looking at about 26.6. Okay, so we can see that Hong Leong Finance in the financial ratios did better than the DBS group. Now for the payout ratios, this is a very contradictory kind of viewpoint. Now you can see a good payout ratios of 60 means that Hong Leong Finance like to reward the shareholders. For every $1 they make, they like to reward 60%. Okay, as dividends to shareholders, whereas DBS only reward about 20%. Okay, so what does that mean? The good thing is high payout ratios means investors have higher dividends, but in the longer term, maybe 5 to 10 years down the time road, the companies grow at a slower pace because there's less cash in the company to grow. Okay, whereas a low payout ratios means the company pay less to shareholders. As such, they have more cash on hand to grow the company. In this case, DBS will have a longer growth, have a steeper growth as compared to Hong Leong. Hong Leong will have a gentle growth as compared to DBS. So it's a plus and minus point in this angle. If you're looking at 10 years down, well, DBS in this case, I can definitely tell you payout ratios so low, definitely they will enjoy better share price movement in the 10 years down the time or maybe 5 years down the time. But as for now, a lot of people prefer to have higher dividends because this is cash in our pockets. So definitely Hong Leong have a better proposition. Okay, now we'll look at the PE ratios. Hong Leong Finance still did better than DBS, is trading at 12 PE, whereas DBS trading at 14 PE. Book value ratios, okay, Hong Leong is trading at discount, whereas DBS you're buying at premium. Okay, so in this case, there's a lot of plus points on Hong Leong over DBS if you are looking for investments. Okay, similarly, let me look at their interest income. Both of them enjoy good growth over the years. Alright, in terms of profit wise, similarly they are enjoying pretty good decent profits. Okay, and similarly when it comes to accounting book value, they are experiencing the same kind of about the same rate of growth. Okay, I would say that's what you can see here, from 34 billion here to 47 billion. There's a greater percentage in difference as compared to Hong Leong. Hong Leong is experiencing a slower growth as compared to DBS, but you can enjoy a higher dividends. Okay, dividends means cash in your pockets, but in the long run you probably lose out the race. It's basically that's how the game goes. Right, so here we got so we can see dividends. They're enjoying a much higher growth in dividends as well. Last year was a fantastic year. DBS reward shareholder fantastically, but otherwise they have been remaining constant. But with this maintenance, I really doubt so. DBS have not been that generous over the years. Okay, so I do expect some decline in DBS over the next 1 year time share price. Yes, it's growing, but because a lot of this was influenced by the high dividends payout last year. Otherwise, it had always been a very moderate dividend paying company, whereas Hong Leong is more generous in the dividends, as what we can see in the ratios. Here it's only about 30% or maybe 40%, whereas here we can see it's about 60% payout. Here similarly about 30%, here another about 30% payouts. Yeah, so you can see it's hovering around 30% except for 2017, an exceptional year. So Hong Leong Finance is definitely um, is a better rewarding company if you are looking at dividends. So this is Hong Leong Finance. Now let's take a look. Maybe we compare it with another company. Just for a quick one, let's see if let's just let me get prepared. Okay, so give me a moment. So let's try and compare it with OCBC. Hold on a moment. Okay, let's OCBC. Now we're comparing it with OCBC. Alright, so as all I can see here. Okay, now the beta of OCBC is still a little bit higher than Hong Leong. Hong Leong is much lower beta, that means lower volatility, higher volatility for OCBC. The long-term debt to equities, Hong Leong has no debts, OCBC have long-term debts. Alright, so Hong Leong Finance wins in terms of lower risk. Okay, net profit margins, Hong Leong have better net profit margins. Dividend yields wise, Hong Leong Finance still have greater dividend yield as compared to OCBC. But in terms of payout ratios, okay, this is ambiguous. Nonetheless, payout ratios definitely means higher dividends, while lower payout ratios mean less dividends. PE ratios wise, OCBC wins over Hong Leong. This presently trading at 11 PEs, while Hong Leong trading at 12 PEs. Book value ratios, Hong Leong wins as trading at a much discount, OCBC trading at a higher premium, slight premium. In terms of business growth, interest income growth, both companies enjoy good growth, but nonetheless I do see 60 million here increase as is about 20% growth over past 5 years. 3 billion increase as compared to 2013 is about 50% growth. As what you can see, lower payout ratios have a better growth in okay. So as what you can see, last year OCBC did very well as compared to Hong Leong, a very stagnant, very slow growth, but OCBC have a better growth. But Hong Leong have given more dividends, more safe sense of safety. Alright. When I come about equity accounting book value, I think this OCBC did better as compared to Hong Leong. And in terms of dividends, OCBC remained a very steady state of dividend distributions. So that's what you can see. Okay, Hong Leong did similarly well. So nonetheless, if you're looking for growth, I think OCBC would offer better propositions. If you're looking at dividends, Hong Leong Finance has better propositions, give you a lot of dividends and no long-term debt. All right. And lower volatility, whereas OCBC a little bit more volatility to Hong Leong. So that's why you can see Hong Leong still have a pretty good attractive point to invest. Now let's look at the charting wise. Okay, this is the monthly chart of Hong Leong Finance. Okay, this was in 2009 when Lehman Brothers incident happened. Thereafter, the share price bounced, but nonetheless, as what you can see, it have been holding steady and a gentle increase here. So let's take a look at the shorter terms, maybe about 3 years. Okay, so okay, in 2007, okay, there was some corporate announcements as caused this share price hike. Thereafter, the share price had always been bouncing around these regions. And so I can see, what's what I can see from the candlesticks. This share price right now, the ratios, the share price has been supported at about 2.6 or 2 point around these regions, because as I can see a very good candle here, very good support candle. But nonetheless, there is some resistance here at about the range of 2.8 or 2.7 plus. Okay, so if you're looking at short terms, okay, this is the range you should be trading. Okay, if you're looking at long term, this is definitely a dividend investment if you are really looking at dividends. Alright, this is the monthly candle. Let's take a look at the weekly candle and see what we got. Okay, so this is the weekly candle. That's why you can see the share price have been bouncing around these regions. Around the share price of 2.61 to 2.62 is a pretty decent attractive point if you are looking to buy and collect dividends. So this stock definitely worth some consideration to be in your watch list if you are looking for dividends. Okay, but nonetheless, range of about 2.7 or 2.8, there's some resistance here. It's good to sell it off for some profits, but nonetheless, because of the dividends, in case you're busy, these stocks still offer you some pretty safety net to constantly reward you with dividends. This is the chartings of this stock. So be it from the fundamental aspects or the charting aspects, these stocks are is pretty fine. So that's about all for my videos. So I hope you guys enjoy the videos. So if you have any questions, just drop me my email shown over here. So that is about all for today. So I hope you guys enjoy so my videos on Hong Kong finance. So hope to see you guys. Goodbye.